Hello and welcome to edupediaworld.com. Today in this part we'll be studying about some major economic concepts and their use in business decision making. Our first concept is the opportunity cost concept. As we all know that there is a scarcity of resources as well as there is alternative use of those scarce resources. So these two fundamental truths, that is a scarcity of resources and alternative use of resources, gives the rise to the concept of opportunity cost. Let's take an example. Suppose a firm has $100 million investable funds and it has three risk-free alternative uses of this fund. It can invest this amount in expanding its business. It can invest this amount in setting up a new project. Another alternative use is it can invest this amount in buying shares in another firm. So these are three alternative uses, and we also know the expected return from these uses. The first alternative gives us a return of suppose $20 million. The second alternative gives $18 million, and the third alternative gives $16 million. Thus, being a profit maximizing manager, I will go for the first alternative, that is expanding the firm, the size of the firm, and I will get a return of $20 million. Now the second best use of these resources of 100 million was investing to get a new project, and I was getting a return of $18 million. Thus, in order to get $20 million, that is the best use, I am foregoing $18 million income. This foregone income, which is earned through the second best use of the resources, is known as opportunity cost. Thus, summing up, we can say that opportunity cost of availing an opportunity is the foregone income expected from the second best opportunity of using the resources. And in this particular example, the opportunity cost is 18 million, which this income I have foregone in order to earn 20 million, which is the best use of my resources. Now let's understand that what is the concept of economic profit or economic gain. See, in our example, the best alternative use of the resources was the first alternative, and the second best use was the second alternative. The difference between the best alternative use of resources and the opportunity cost, that is $20 million minus $18 million, is equals to $2 million, is my economic profit or economic gain. The difference between actual earning and its opportunity cost is called economic gain or economic profit, and in our example it was $2 million. The concept of opportunity cost assumes a great significance where economic gain is neither significant nor very large because it requires a careful evaluation of the two options. For example, suppose a firm has to take a decision on whether to fire an efficient labor officer for treating his labor force unkindly in settlement of a dispute with the labor union or to allow the matter to be taken to the labor court. Now here in this case, if the firm decides to fire the labor officer, then the loss of an efficient, reliable labor officer is the opportunity cost. Whereas if it decides to go by the labor officer and not to settle out the dispute with the labor union, then the opportunity cost will be the strikes, the lockouts, the decrease in the efficiency of the labor which will happen because the labor are not satisfied with the decision of the organization. Thus, here it is very important to evaluate the economic gain so as a particular decision can be taken effectively. Next we come to the marginal principle. Let us first understand the meaning of the term marginal. The term marginal refers to the change which can be increase or decrease in total quantity or value due to a 1 unit change in its determinant. Suppose the total cost of producing 100 units initially was $2,500. Now the firm decides that it will increase the production by 1 unit because in marginal we just study the increase or decrease in the total cost or total revenue when there is just increase or decrease of just 1 unit. So the firm decides to increase the total cost, total number of units produced by just 1 unit. Now the total cost of producing 101 unit becomes equal to $2,550. Thus, if we want to calculate the marginal cost, it will be equal to total cost of producing n units, that is 101, minus total cost of producing n minus 1 units, that is 100 units, which will be equal to $50. Now likewise we can also calculate the marginal revenue. Now total revenue by selling 100 units initially was suppose coming to $3,000, but after we started selling 101 units, the total revenue increases to $3,100. Therefore we can also calculate marginal revenue, which will be equal to total revenue of selling n units minus total revenue of selling n minus 1 units equals to $100, that is $3,100 minus $3,000. Thus summarizing, we can see that marginal cost is equals to total cost of producing n units minus total cost of producing n minus 1 unit. Now comparing the marginal cost and marginal revenue helps us to take a decision. See, in this example, our marginal cost is $50, whereas our marginal revenue is $100. So we can see here that we are earning a net profit of $50, that is marginal revenue minus marginal cost. If by taking a decision, if a manager analyzes that by taking a decision a firm earns a net loss, therefore that particular decision will not be taken. But by comparing, if by comparing the marginal cost and the marginal revenue, if the firm sees that it is earning profit, then that particular firm will go for that decision. This concept, this principle also helps us to take decision regarding that up till what time period a business activity should be carried out. A business activity should be carried out so long up till when its marginal revenue is greater than the marginal cost. And for a profit maximizing output, the marginal cost must be equal to the marginal revenue. Now next we come to the incremental principle. As earlier in marginal principle we have seen that we use marginal principle in those cases where the firm decides to increase or decrease its total units by 1 unit. But generally, practically, the firm does not takes a decision on the basis of increase or decrease of just 1 unit. They take a bulk decision. Thus, in those particular cases, incremental principle plays a very important role. The incremental principle is applied to business decisions which involve bulk production. Increase in total cost and total revenue is called incremental cost and incremental revenue. For example, suppose a firm decides to introduce a new plant in its organization. Now here the total cost of production increases from $100 million to $115 million. Thus we can see here that there is an increase of $15 million. Now this increase in the total cost is our incremental cost. Now after using this plant, we produce some products, we produce bulk products, and then we sell these products in the market. Initially our total revenue was $200 million, but after this plant and by selling the products produced by this plant, our total revenue increases to $250 million. So in this case, the difference between the current revenue and the initial revenue is our incremental revenue. Which is equals to $50 million. Thus, in this particular case, we will be comparing the incremental cost and the incremental revenue. The incremental revenue is equals to $50 million, whereas the incremental cost is equals to $15 million. Thus overall the firm earns a profit of $35 million. Therefore the firm will decide to introduce this new plant in the organization. This is how incremental principle helps a firm to take a decision. Now, incremental cost, as we have studied, is divided into three parts. First is present explicit cost. The present explicit cost can again be divided into two parts, that is fixed cost and the variable cost. The fixed cost is the cost of plant and building. The variable cost includes cost of direct labor, material and overheads like electricity and indirect labor. Next we come to the opportunity cost. As we have already studied, opportunity cost refers to expected income foregone from the second best use of the resources. Next we come to the future cost. Future cost of a business include depreciation and advertising cost if the product does not sell as well as expected. Thus, the incremental cost is divided into three parts. We have already understood with the help of an example that incremental cost is the increase in the total cost of production due to a business decision, whereas incremental revenue is the increase in the revenue due to a business decision. We use the principle to take the decision regarding whether we should go for a particular proposal or not. The decision rule says that if the incremental revenue is more than the incremental cost, then that proposal is accepted, else rejected. As we have seen in our example, that our incremental revenue was more than the incremental cost, so we have gone for accepting this proposal, that is, we will be introducing the new plant in the organization. If the incremental revenue was less than the incremental cost, then we would have gone for rejecting this particular decision. Now next we come to the principle of contribution analysis. Contribution analysis is basically related to the incremental principle. We see and we compare the incremental cost and incremental revenue. Whatever is the difference is the contribution towards the business. Thus, the contribution of a business decision can be defined as the difference between the incremental revenue and incremental cost associated with that particular decision. Now this particular principle actually helps us to take the following types of decision, that is whether or not to accept a project, whether or not to introduce a new project, whether or not to accept a fresh order, whether or not to add an additional plant, and whether to make or buy. Next is our Equi marginal principle. Now this particular principle was over time applied by business managers to allocate resources between their alternative uses in such a way that they are able to maximize their profit in case where the firm carries out more than just one activity. Now this particular principle suggests that available resources, that is inputs, should be so allocated between the alternative options in such a way so that marginal productivity gains from the various activities are equalized. To understand the concept in a clear way, let's take an example. Suppose a firm has $100 million. This particular resource the firm can spend on three projects, A, B and C. Now each of these three projects require a unit expenditure of $10 million, and let us suppose that we have the marginal productivity chart of spending on these three projects. project A, B and C. The unit expenditure is $10 million. Let's see how does a profit maximizing manager will allocate his resources. We know the marginal productivity from spending the units on these projects. And 12. This is the marginal productivity chart we can see. Now each and every unit requires a expenditure of $10 million. Now as we can see that in order to maximize the profit, the first unit will be used on project A because the maximum marginal productivity is given by project A. Then again the second unit will be again utilized by project A. Then the third unit will be utilized by project B. Fourth unit will be utilized by project C. Fifth unit again will be utilized by project A. Sixth unit by project B. Seventh unit by project C. See, I am allocating the units in terms of the productivity provided by the project. I am going in a descending order. Starting with the maximum productivity, I am going towards down. 8th unit will be utilized by project B. 9th unit will be utilized by project C, and the 10th unit will be utilized by project A again. See, we can see here that we keep on allocating the units until the marginal productivity from all the three projects becomes the same, that is 20 20 20. Thus a profit maximizing manager will allocate his resources in this particular way. So we can see that in project A, in order to maximize the profit, a manager has invested $40 million. In project B and C, he has invested $30 million. This is the way he has done the allocation of resources. No other way will be able to give a profit better than this profit. This is the maximum profit which can be given by allocating the resources in such a way. Thus, we can conclude that the Equi marginal principle, in order to get the maximum profit, the resources should be allocated in such a way so that the marginal productivity from A should be equal to the marginal productivity from the alternative use B, should be equal to the marginal productivity from the alternative use C, and all the other alternative uses. Means whatever the alternative use we are doing of the resources, the marginal productivity of all the alternative uses should be equal. That is, MPA is equals to MPB is equals to MPC is equals to MPN, the number of alternative uses which a project, which a resource can have. This principle can only be applied where investable resources are limited. First condition. Second condition is where resources have alternative uses. And the third condition is that the alternative uses are subject to diminishing marginal returns. Means as and when we are allocating the resources to the alternative uses, the marginal return should keep on decreasing by the use of the available resources. Last but not the least principle which we'll study under this head is time perspective in business decisions. A manager should take into consideration after what time period a particular business decision will reap results. The time perspective refers to the duration of time period extending from the day the decision is taken till the time it shows some results. For example, a decision to buy explosive materials for manufacturing crackers involves short-run demand prospects, whereas investment in plant, building, machinery, land, spending on labor welfare activities, expansion of the scale of production, etc., are long-term investment decisions. Such decisions may not be profitable in the short run but may prove very profitable in the long run. Therefore, managers must assess and determine the time perspective of business, that whether a decision is for short time period or a long time period of a business proposition well in advance and make decisions accordingly. Thus concluding, these were some very important fundamental concepts which are of significant use in managerial economics. In all, we have studied about 6 fundamental concepts. First one was the opportunity cost. Next was marginal principle. Third one was incremental principle. Then contribution analysis. Then the Equi marginal principle, and last one was time perspective in business decisions. Thank you.